But for those of you who are here today, thank you so much for taking time to attend the session. So my name is Leslie Mena, and I'm an associate consultant here at SLR Consulting, based out of our Singapore office. I'm also joined today by my colleague, Emma Album, who is a managing consultant at SLR, based out of our New Zealand office. So very quickly, just before jumping into the webinar, just some quick housekeeping notes to keep in mind. Firstly, the session is being recorded, so everyone here who has registered today will receive access to a recording afterwards. We'll also be hosting a very short Q&A session at the end of this webinar. We'll try our best to make sure that there is enough time at the end, but just in case we do end up running out of time, we will be collecting any questions, which we will follow up on after the webinar. So do feel free to just pop any questions that you have into the chat using that little Q&A button right there on the screen. And then secondly, we also want to acknowledge that today's session, as well as the session that we held last week, is being supported by the ICAEW Hong Kong, the Institute of Chartered Accountants. I think some of their members are here today, so for those of you, thank you. And then just moving on to today's agenda. So the webinar today will focus on quantifying the impacts of physical risks, starting first with a recap of the IFRS reporting requirements, as well as an introduction to physical risks, before we move on to an overview of how companies should go about quantifying physical risk impacts, including some worked examples. Just as a note, in addition to today's webinar on physical risk and last week's webinar on transition risk and opportunities, we've also delivered a number of webinars and blogs on climate reporting and scenario analysis. So for any of you out there who might be new to this topic or just want to know more, do feel free to reach out to us after the webinar or visit our website for more information on this topic. And very quickly, just a quick introduction to us, to SLR. So for those of you who might be a bit unfamiliar with who we are a sustainability solutions provider with expertise across more than 45 technical disciplines and offices around the globe. So Emma and myself are part of the global advisory team, but across the wider SLR team, we also do have a team of ecologists, engineers, and other specialists who are able to support the implementation of solutions. More specifically, within the APAC region, we operate across Singapore, China, Australia, and New Zealand. So as I had mentioned earlier, today's webinar is actually a continuation of our Cost of Climate series. I think some of you may have attended last week's webinar. For those of you who might have missed it, last week's webinar talked about quantifying the impacts of transition risk and opportunities. So that included assessing the materiality of those risks and opportunities, ways to disclose information, as well as some worked examples. Again, for anyone who is interested, a recording of that webinar is available to access through this link that we've put here right there. But I guess moving on to the actual content, I'll now pass it on to Emma, who will walk you through the next couple of sections.
Perfect. Thanks, Alyssa. So yeah, just to start us off, I'll share a little bit about the context and requirements of IFRS and related standards like the New Zealand climate standards. And just to set the stage a little bit, as we all know, climate change is significantly increasing the frequency and intensity of catastrophes globally. Those catastrophes have direct economic costs. And a recent report from Gallagher estimated that last year, those costs were about 20% higher than the average of the past 10 years and 32% higher than the average of the past 20 years. So they're big and they're increasing. And because of the risks posed by climate change for the last decade or so, there's been ongoing development and application of standards to report consistent and clear information related to those financial risks. And as Alyssa mentioned, we had the first part of the webinar series last week, which dove into a little bit more depth on the requirements of those standards. And just given that quite a few of you likely watched that one, we're going to spend a little bit more time talking about the physical risks themselves and the details of how to quantify them rather than diving into the requirements. That being said, I do want to highlight that for IFRS S2 and also the New Zealand climate standards, is that organizations are required to report both business information and financial information. So the business information needs to address the full value chain and the response to those physical impacts. And then the financial information should cover both current and anticipated impacts. But there's actually a step between those two, which is using the financial and quantitative information to inform the strategic decisions that feed into the business information, which is what we'll focus on today, is how you connect that financial information and the business information on the back end to make sure that what you report out is robust and that you've got all the information that you need in order to make good choices. So it's all well and good to say use quantitative information to make strategic decisions, report financial impacts. But for something like the physical impacts of climate change, those impacts and the risks are uncertain and they aren't really measured in financial terms, so in quarterly or half-yearly increments. What this means is that we use scenarios to assess those potential future impacts, which is in accordance with the standards. And as you can see, there are greater physical risks in the long term under higher temperatures and emission scenarios. But even in the next few years, the next decade, we can see that there's an elevated risk compared to 20 years ago, in alignment with that report from Gallagher. And given that many of the people on the call have likely undertaken at least a qualitative assessment of risks under different scenarios, I'll just mention that when it comes to quantifying those physical impacts, the scenarios selected, the assumptions and narratives that go along with those scenarios, the time horizons, all of that is really important to the final outputs and the usefulness of those outputs, which you'll see as we go on. So just quickly, before we dive into more of the how on all of this, I want to highlight that when we talk about physical risks, there are event-driven risks, and then there are the longer-term changes in climate patterns. And we typically account for these differently in the quantitative assessments. So for those acute event-driven risks like cyclones, heavy rains, floods, heat waves, we tend to think about this in terms of the likelihood of a specific category of risk occurring in a given year or cumulatively over a period of time. Whereas for the overall changes or chronic risks like sea level rise, changing precipitation patterns, these are usually more linked questions on whether the organization can operate within a specific threshold. So an example of this would be for an electricity generator, looking at the efficiency and capacity of generation at different temperature thresholds and the associated revenue with that. Again, I imagine that many of you are familiar with acute and chronic risk, but just kind of thinking about that context in terms of translating it to the quantification. So into the actual process and a bit more of the how of how this is done. So as previously mentioned, IFRS requires the use of scenarios to project future impacts, but it's really important to understand what you're trying to analyze and quantify so you get results that are meaningful in terms of the usefulness to your organization and also grounded in reality and science. So these first few steps around identifying the physical risks and as well as the assets and activities that are exposed to those hazards, those are likely the ones that people on this call have already done. It's part of most qualitative assessments. And as mentioned last week, we've done other sessions covering those two steps. So I'm going to gloss over them today, but just noting that they are absolutely essential for all the other steps we're going to talk through. So once you've done the identification of those risks and assets, it's quite common to just go immediately into steps 3 and 4 around scenario analysis and impact assessment. However, there's a really important interplay with those two steps, and they can be done at different levels. So from using public data sets to make qualitative assessments to having highly tailored data that gives incredibly specific information on impacts that can then be used to inform things like the design of large and complex assets or the suitability of long-term investments. But in order to progress to step 5, which is where we're actually quantifying those financial impacts, it's really useful to pause and evaluate the purpose, the scope, the limitations of those first 4 steps, so all the work that you've done, because there may be a need to go get more specific data to support that quantification. For those who tuned in last week, this is quite similar to the calculation pathways and approaches that we discussed. And we'll talk more about what the data that requires momentarily. Next slide, please. Thank you. So when you do that pause before quantification, what you should be doing at that stage is really putting some boundaries on the analysis and having a really clear understanding on what are the material assets and parts of the value chain, what are the critical dependencies. So because as you go through, you need to understand the relationships between them, which suppliers, which customers, which sites contribute to your financial performance and how. If you don't have that understanding, it's quite difficult to actually do the financial quantification because all you're doing is assigning numbers to a relationship that already exists. Perfect. So back to the data side of things. So I mentioned that getting to financial quantification may require additional or different data than what you might have used in past analyses. This can range from country level data, which could be even as simple as a directional Indonesia is exposed to increased mean temperatures and cyclones. And this type of sort of really high level data is suitable for building an understanding of potential risks, particularly in the value chain. And it's often used at those first stages in the process. But this can then be extended right through to bespoke modeling, which we have over on the right-hand side. And that gives you that really detailed and specific information on your operations. But if you haven't dealt with climate data before, it can be quite challenging to interpret and then actually connect it to the financial impact. So the data is only as good as what you can do with it, which is why there are trade-offs between them. So you should also always be asking yourself what level of data is right for you. And there are trade-offs between availability, specificity, cost, the time, and you really want to be asking yourself how you're going to use the outputs, because that's going to help determine what the level of data right for you is. So some of the trade-offs that you can think through in terms of public data sets is that they are less expensive, they're more readily available, they use established standards and methodologies, but the data itself may be difficult to interpret. And it may not capture some nuances that you need. It may also not have everything that you need. And the analytical approach may vary significantly between sources. So if you have a very large value chain that's global, you may need to use global data, but it may not be granular enough. Conversely, if you use more granular data that's still readily available, it may not be comparable between the two. On the flip side, if you get bespoke or custom modeling done, it's very customizable. It'll be exactly what you need while still being based in those global scientific methodologies. It also gives you some detailed and very specific insights, and it has a more nuanced understanding of those potential impacts. But it can be a bit complex to develop and implement, requires a decent amount of capacity in order to utilize to its best advantage. It's also a little bit more expensive, and it may be influenced by the biases of data providers, which, that being said, for either public or data or custom modeling, the biggest thing that you want to find is make sure that you can get your hands on the methodology. This is important not only so that you can have confidence in the science and the approach, but also so that you can go through an assurance process, which is required by many of the jurisdictions that are aligning to the IFRS S2 framework and similar frameworks. I'll just have one more note, which is that you can use different types and sources of data for different parts of your value chain, but you just have to have some careful attention on that methodology, particularly on the scenario assumptions. Cool. So as I mentioned, when companies are doing this analysis, it's really important to look at the critical dependencies. And this is because there are specific hazards or climate perils that can impact both your sites and your value chain, or either your sites or your value chain. This then leads to the direct financial impacts, such as repair costs and decreased production, or indirect financial impacts, such as increased insurance premiums or material costs or asset devaluations. So how can we think about these financial impacts? What we use is value at risk, or VAR, in order to estimate the direct and indirect impacts from physical climate hazards. There's two main parts of this, and I realize that this is a very simple graphic to illustrate this point, but those parts are value risk from damage and value risk from productivity. Both of them have the same underlying logic, but slightly different inputs to capture both that direct and indirect impact. So the logic is that you start with the value at risk as a percentage in the reporting year. You multiply that by the asset costs or the revenue, which is fully aligned with your financial reporting, or it should be, in order to get to the total value at risk, which is in turn a sum of the value at risk from damage and the value at risk from productivity. A simple idea, there's quite a bit that goes into it. And what that, one quick. And for that, there's some scenario data that goes in, as well as your operational data. And then the final output is the financial data that you then need to report on. So in terms of the scenario data that goes into that, for the value at risk from damage and the value at risk from productivity, this is driven by the scenarios in climate modeling. So it takes into account things like the probability of the climate hazard, the probability in the underlying scenarios, the baseline risk score for the hazard. For example, is the asset in a flood-prone zone already? And then an adaptive capacity score, which can either be generic or custom, depending on sort of where you're at with your analysis. But where the value at risk from damage and the value at risk from productivity differ is looking at the expected annual damage and applying it to a building type specific vulnerability score for value at risk from damage. And then for the value risk from productivity, this is more about the expected loss, as well as a function specific vulnerability. So for example, in agriculture, looking at the farm productivity. So with that, I'll hand it back over to Alyssa to work through some worked examples.
Yep. Great. Thanks, Emma. So in this section, we're just going to go through some examples of those calculation pathways that Emma has just talked about. So as she just mentioned, there are a number of different sources that companies can collect data from. So on the slide here, I have an example from Clim Systems, who is our climate modeling partner. And generally speaking, I would say that physical risk data generally comes in the form of either hazard metrics or VAR, value at risk. So when we talk about hazard metrics, these are non-financial but quantitative measures of physical hazard. So for example, this could be the amount of rain that a certain region receives during a storm, or it could also be the number of days that a certain region experiences heat waves in a year. And I would say that for companies who are just starting to assess their physical risk, this type of data is usually easier to get because it's very readily available on public databases, whereas VAR, value at risk, is usually only available using bespoke modeling. And again, as Emma mentioned, this is because of the resources and complexity that are involved in calculating that value at risk. But both sets of data can be used to quantify the impacts of physical risks. In the next couple of slides, I'll walk you through two examples of how companies might do this. So starting off with value at risk, I think of the two types of data, quantifying impacts using VAR is generally the most straightforward approach. But I will say that, again, as Emma just mentioned in the previous section, it does require quite a bit of information. Firstly, on the location and building material of your assets to generate those VARD and VARP figures. And then secondly, the capital cost of your assets and the revenue to actually do the calculations themselves. And I would say that because of this approach is generally more suitable when you're looking at quantifying the impacts of your own direct operations. And this is mainly because that kind of information is quite easy for a company to get from its own operations. So if we look at an example of how to use VAR to quantify physical risks. So in the specific example that we put together, a company has carried out a climate risk assessment of all of its sites, and they've collected VARD and VARP data for each site, and this is covering a number of physical hazards. So in order for this company to estimate the potential financial impact from asset damage, what they would do is they would simply multiply the capital costs of each of their assets by its respective VARD. And then similarly, if they were interested in estimating the potential financial impact from productivity, which in very simple terms, which would be kind of like disruptions to their operations due to, let's say, severe weather events, the company would very similarly just multiply the revenue of each asset by its respective VARP. And then the total financial impact from fiscal risk is then the sum of these two products, which I've kind of highlighted there in the two kind of like dark black boxes. Just a couple of things to note though. I think while these calculations are very straightforward, I think there are a couple of key points worth noting. I think number one, when we're assessing impacts across different scenarios, obviously, it's very useful to have some kind of baseline or reference point to compare those impacts to, which is why we've subtracted that baseline VARD and VRP from that VARD and VRP in the reporting year. And so essentially when we're looking at value at risk from damage and value at risk from productivity, it's actually the increased potential financial impacts from those hazards compared to the present day. Second point that I do want to note is that when you're looking at VARD and VARP values, these generally don't take into account mitigation or adaptation measures that are already in place. So let's say, for example, a company has an asset that is located near a body of water and is generally prone to flooding. So they might already be putting up some kind of flood barriers in parts of their buildings, which would potentially lower that asset's vulnerability to flooding. But I think at this point, the level of data is a little bit too granular to take into account. So something just to keep in mind when you're doing these calculations. And I think just the final point, because the VARD and VRP figures can be broken down by assets and hazards, these calculations can be carried out on either a consolidated basis, so covering all of your assets and all of these physical hazards that they're exposed to, or on a per asset or per hazard basis. I think some companies might find it useful to break down impacts by asset or hazards because it does give additional insights like which of our assets are most exposed and vulnerable to climate change, or which hazards are most material to our operations. So that was an example of how you would use VAR to quantify impacts on the company's own operations. And then moving on to the next section, we'll quickly look at an example of how a company might use hazard metrics to quantify physical risks. So in this example, let's say a palm oil company uses publicly available databases to collect information on how FFB yields may be impacted by climate change. And just for context, because I just realized that maybe some of you out there might not be familiar with palm oil, FFB stands for fresh fruit bunches, and it's essentially the raw material that is used to make palm oil. So to quantify the potential financial impact, what the company might start by doing is multiply that current FFB yield by the projected decline to estimate, okay, this is how much FFB we could potentially lose due to physical hazards. And then they can multiply this loss by a conversion factor and the unit cost of palm oil. And the final product that is being calculated is the potential loss in revenue due to a decrease in production capacity. But okay, like let's say that the company also wants to ensure that they can meet consumer demand. So they also decide to buy more FFB from its suppliers to compensate, which would also result in additional operating costs. So the impact from this can similarly be estimated by multiplying the amount of additional FB material that they buy from suppliers by that unit cost. So essentially, let's say this is an example of how an agricultural company would try to quantify those financial impacts based on the hazard metrics that they were able to collect information on. So I think you can see that compared to using VAR, this approach is a little bit less straightforward, and it usually does require quite a bit of thinking to be able to convert those metrics into financial impact. I would say that this example specifically is quite straightforward, but you can imagine that quantifying something of quantifying the impacts of something like, let's say, floods or blockages quickly become more complicated. So maybe something to keep in mind as well when you're thinking about what type of data you want to use and what kind of sources of data might be suitable for you when you're quantifying those impacts. But noting that we have just 5 minutes left, that actually brings us to the end of our webinar, and opens us up to the Q&A question.
And as Alyssa said at the top, for any questions, we have the Q&A function within the team screen. And I can see that we have one in here around what is the minimum amount of information that I need in order to quantify the climate risks. And I'll let Alyssa take that one, given that she just talked through the sort of two main approaches on hazard metrics versus VAR.
Sorry, I'm sorry, I'm having some connecting issues. Can you repeat that question, please?
Yeah, absolutely. It's about the minimum amount of data required in order to get to like the right approach. So in order to get to climate risk. So for the hazard metrics and the VAR, which one requires the least amount of data essentially?
Okay, I would say that for actually calculating the financial impacts, I would say VAR probably requires the least amount of data because we're just talking about being able to capture, okay, how much, what is the capital value of your asset and what is the revenue of those assets. But I think we also need to think about the kind of resources and information complexity required to actually get those VAR values versus those metric hazards. So again, as I mentioned, and as I'm also kind of mentioned in the couple of last sections, VAR, because it's usually only available with bespoke modeling, there is kind of like quite a bit of information that goes into actually calculating those values to begin with versus, let's say, if you go to some kind of public database, so let's say like the World Bank has some couple of databases on like temperature impacts or precipitation, things like that. Getting information like hazard metrics are very, very easy. They're publicly available and therefore quite free to get. Whereas if you're looking at VAR, you do either have to engage a, let's say, third-party company, like let's say Clim Systems, to actually carry out that modeling for you, or if you have those capabilities in-house, put in those resources to actually do those calculations yourself. So again, I think it really depends on where companies are in terms of assessing their physical risk and what kind of capabilities and information is available.
Absolutely. And I'm seeing some questions filtering in. And I think that kind of answers one of them about whether it's imperative to have the bespoke modeling data in order to make accurate calculations. The short answer is no, but it really depends on kind of what you have internal capacity wise, as well as what you want the outcome to be ultimately. I think we have time for at least one more question. We'll see how we go. But I'm seeing one here about what happens when you go through the calculation and then the actual impact amount is not material, whether or not you still have to disclose it. Do you want to answer that, Alyssa, or I can?
Okay. Do you want to go first?
Sure. The short answer is that it depends on what jurisdiction you are in. So some require it to be reported, and the definition of material changes depending on both the legislation as well as your own definition of materiality. In general, our suggestion would be to report things even if they aren't material, in part because it shows that you are making progress towards analysis. And it's unlikely that by the time you get to the point where you're actually calculating financial impacts, that things aren't going to be material, in part because in those upfront stages, you want to prioritize the most important risks to calculate because you don't want to go through all of this effort for things that are unlikely to be that material. Lovely. And I think that actually brings us to time. So with that, I see there are a few more questions in the chat, so we'll follow up on those via email. But with that, I'd just like to thank everyone for joining today, and I hope that you found this session useful. Alyssa, did you want to close with anything?
No, but again, just like thank you for everyone for taking time to attend the session. As Emma mentioned, any questions that we haven't answered within this Q&A section, I know there are a couple that have been posted. We will follow up after this. So if anyone has any questions that they come up with after we end this webinar, please feel free to send those over as well. All right, and that brings us to the end. All right, thank you, everyone.